Many people lose the opportunity at buying a great storage deal, not because it's not a good deal, but because they don't understand how to structure the deal and they don't understand which loan product makes sense for the deal itself, right? SBA when they should use seller financing when maybe you should use bank financing or bring on a private lender or an equity partner. Basically, matching the wrong financing strategy can kill the deal. When you match the right strategy to the right facility, you can close with confidence, gain momentum, increase the value of the facility, generate cash flow, and live happily ever after. Now, look, every storage deal has a better way to finance and structure the deal. How to choose the right one for the deal is oftentimes can be elusive and it can be difficult and challenging. And that's what I am going to break and help you solve today. Okay. Now, last time we talked about how beginners, no matter where you are in your storage journey, can get funding on a storage deal, regardless of your situation in terms of credit, experience, or even if you don't have capital. And that has opened up a lot of eyes. Today, we're going to go a lot deeper. We're going to understand how to know when to use the proper financing. We're going to talk about the pros and cons of the various financing options out there. It's something we call within the Storage Wins community the funding options map. And knowing which financing strategy fits the deal that you're analyzing so you can help get the deal closed and you can get it over the finish line. That's what it's all about. People spend so much time focused on how to find the deal, and with good reason, because when you know how to find deals, it opens up a lot of doors and opportunities for you. But funding is a big piece of this entire storage equation. So let's go ahead and dive right in. I think there are 4 factors that decide which funding strategy fits the deal that you're looking at. All right. And I'm going to quickly go through these. You have the deal type, you have your particular situation, the seller's motivation and their situation, and then you have the actual lender fit. Now, let's start with the deal type. You have to ask yourself, what type of deal are you looking at? Is it a facility that is already stabilized, meaning it's got high occupancy, it's generating consistent revenue, etc.? Or is it a value add, meaning maybe occupancy isn't as healthy as it should be? Maybe it doesn't have a lot of the bells and whistles and things that you plan to add to the facility to increase the value, like fee income, automation, marketing, things of that nature. Maybe it's an expansion play. So you have to understand, what are we working with in terms of the actual facility? The more value add that you need to put into a facility, the more flexibility may be needed. Okay. Because if we're looking at a facility that's 30% occupancy, then it might not be bank financeable, meaning a bank might not be willing to lend on it because it's just not generating enough revenue. And the debt service coverage ratio, which is something we talked about in the previous training, is going to be way off. So if it's more stabilized, then that can open up more doors and opportunities for you. But regardless of the deal type, there is a product or a way to structure the deal and get it funded and financed, provided that you're able to show, here's where it's at, here's where we can take it, and you can create that value. Number 2 is you have to think about your particular situation. Okay, and everybody's in a different boat. Some people have money and bad credit. Some people have good credit and no money. Some people don't have credit or money. Some people have some money and all the credit. So what is your credit situation? Liquidity, right? How much access to cash do you have? Do you have any experience that can transfer into managing, owning, and operating a business? Do you have, how deep is your network, or what I like to call your bench? Do you have strong partners? Are you trying to close fast? Is this your first deal? I mean, there's so many things to consider here with your particular situation. And if you are a first-time storage buyer, then SBA, Small Business Administration, and or seller financing can be fantastic options for you. Even working with a small local bank can be a really good option. I think about Mario and Kate are 2 people within the Storage Wins community that recently bought their very first storage facility, and they worked with a small local lender. Okay. You also have to ask and figure out, what is the seller's motivation? Okay. Are they focused on price? Is it a terms deal? Meaning, are you negotiating and structuring a seller finance deal? Are they looking for speed and convenience, and they're looking to close as quickly as possible? Some sellers like the idea of getting monthly income, and so seller financing can make a lot of sense, especially if they're sensitive when it comes to capital gains taxes. Some need cash because they want to go travel or they want to go do this or that. And so you really, really need to understand the seller's motivation. And that is why it's so critical that when you connect with sellers, you ask questions and you listen. You need to be doing 80%, 90% listening and let them do most of the talking. All right. Now, you also have to ask yourself, okay, well, based on the different options I have, if we were to look at the funding options map, find out with the lender what they require. What are they looking for in a borrower? What are they looking for in a business? Do they require that you have storage experience? Do they have an appetite for value add opportunities? Are they flexible in terms of the timeline? Okay. Debt service coverage ratio. What is the debt service coverage ratio? And remember, the debt service coverage ratio is the net operating income divided by the annual debt service payments that are required. And banks are typically looking for 1.25 to 1.3. So what does that mean? If a facility generates $100,000 in net operating income and the debt service is $100,000, then that's a debt service coverage ratio of 1. That's likely not going to cut it. Most banks want 1.25 to 1.3. It tells the bank and it gives them confidence in your ability to be able to pay off that loan or service the debt. Okay, so these are the filters that you need to run every deal through. And what I want to do is I want to break down each funding option so that you know exactly when to use it. All right. Now, what I think is going to be extremely helpful for you here, and this is something that nobody ever did for me when I got involved in storage that I think can really serve you moving forward, is understanding the pros and cons of the different funding options out there. So let's first start with SBA. And that is the Small Business Administration, which typically has two types of products. You have a 7A or a 504. And SBA can come into the picture if you're a first-time buyer. And by the way, you can be a second, third, fourth-time buyer and still use SBA. But it's usually, if you're a first-time buyer, they tend to attract more of SBA-type products. If there's a value add deal that has upside, like my very first deal in Mississippi fit this criteria. I was a first time buyer. It was a value add that also had upside. This is a big one, is if you need more leverage. What does that mean? Maybe you don't have as much money to put down. And so with SBA, you can put 10 to 15% down, which means that they will give you 85 to 90% leverage. All right. Now, this can be an awesome option if the down payment is a challenge, because maybe you only have a certain amount of money in the bank, or maybe you don't have any money, but you can get access to private money or an equity partner that can serve as the capital injection, is what they call it. Basically, somebody else putting down the money that you need. And so if you compare SBA to a small bank's probably going to require 25 to 30% down payment. Okay, which means they're only going to give you 70 to 75% leverage. Whereas with SBA, you can come in with 10, 15% down and get higher leverage. So the pros, you got a lower down payment. It's friendly to beginners. Oftentimes you can get a longer amortization period or schedule, which can give you better cash flow. So you might be able to get 25-year AM. And then strong underwriting credibility. Okay, so now what are the cons? Because with every pro, there's going to be a con. It can be slow. It's heavy on the paperwork, meaning they're going to require a lot out of you. Not just typically tax returns and bank statements and the P&L and the balance sheet and all that, but they're going to want to see your debt schedule. They're going to want to see your personal financial statement. They're obviously going to check your credit. They're going to want to see a business plan. They may even interview you. I remember my very first deal on a Saturday morning, I scheduled about a half-hour interview with somebody from the underwriting department, and I essentially had to pitch the deal. And I had to answer questions and explain my underwriting, explain my marketing plan. How was I going to take this facility that was generating X and make it X times 2 or whatever, right? So those are some of the cons. And SBA is not going to be great for hairy deals that have a lot of issues and challenges, high capex, meaning you got to put a lot of money into the facility. Maybe the occupancy is a lot lower. Again, that's why SBA for me on my very first deal, 43,000 square foot facility in Mississippi about 5 years ago, 4 to 5 years ago at this point, was a great option. Okay. Now, if you need to close fast, if you don't have access to a lot of the seller's financials, if the seller's looking for speed, then SBA is probably not going to be an ideal fit. All right. So that's just a quick synopsis and recap of when it might make sense to use SBA financing, some of the pros, some of the cons, and when it's an ideal fit. So let's move on to seller financing. One of my favorite ways, because again, I can't walk into a bank and negotiate but a certain amount on the interest rate. I can't dictate the terms. When it comes to seller financing, generally speaking, I can give the seller their price, but I can negotiate the terms. And that's the down payment, the interest rate, and the length of the loan, the term. So seller financing can be great when you're dealing directly with a mom and pop storage owner. Whenever I hear that they own the facility free and clear, or they have very low debt on it, then seller financing can be a great option. If the seller is hypersensitive to their tax situation, seller financing can be a fantastic option. If they have operated the facility for years and they want simplicity, they like the idea of steady, predictable, consistent cash flow, but maybe they've experienced some headaches managing, owning, and operating because they just don't know any better. They don't have the right people, the right systems, or maybe it's just a lack of knowledge. Seller financing can be fantastic. All right. That's exactly what happened when I bought our Florida facility. Is the seller actually generates more passive income today via ACH every single month, mailbox money, without having to own, manage, and operate the facility. He's making more today than when he did managing and owning and operating the facility. Now, in terms of pros, seller financing can be extremely flexible. Like I mentioned, you can negotiate the down payment, the interest rate, the term. You don't have to go through crazy extensive bank underwriting or third-party reports and appraisals and things of that nature. Seller financing is fantastic. It just opens up more doors and opportunities for you to be able to land the right deal. Some of the cons with seller financing is some sellers just might not be open to it. You might have to educate the seller on it. And so you need to be versed on the process. And I like to simplify it. I don't ask, hey, are you open to seller financing? I say, hey, Mr. Seller, if I could get you your price, and I'm not sure that I could, but if I could, would you be open to taking payments over time? That might be a way that you can frame it. A con can be that I've seen a mistake people make is that they have a very short term, and so they got a balloon coming up. A balloon means is that note is paid in full in a certain amount of time. I know somebody that had, I think it was a 24-month balloon, 2 years. That's not a long time to be able to turn a facility around. And then now you're under the gun because you either have to refinance the property, you have to sell the property, you got to go back to the lender or try to work something out. I like to get minimum 5 years on my seller financing, but the facility and what the exit strategy is, the plan, should help dictate and determine how long of a term you want to shoot for. The more, the better. If I can get 15, 20 years, amazing. 10 years, solid. That gives you a lot of wiggle room in terms of what the market's going to do, in terms of interest rates, in terms of your exit strategy. So speaking of exit strategies, you absolutely have to know your exit. Know your exit before you even buy the deal. Okay, that's super, super important. And that applies not just with seller financing, but any way that you buy a deal, however you fund it and finance it. And then typically with seller financing, a certain level of trust has to be built. Okay, and that goes both ways. The seller is going to essentially be the bank for you. They have to trust your ability to repay the loan and to pay as you've promised. And you need to build a certain level of trust in order to be able to negotiate seller financing. And that's exactly what we did, again, in our Florida facility, where our seller wanted a particular price and I was able to meet him there, but I was able to negotiate the terms. And we ended up putting 10% down. So he financed 90% of that purchase price. We negotiated a 3.25 fixed interest rate, 3.25%, which at the time, I want to say rates were like 4.5% to 5%. About 4.5 to 5. Yeah, that sounds about right. And then we got a 35-year amortization period or schedule, right? So that increased our cash flow because it reduced our debt service payments. We weren't beholden to the 20-year AM that a bank is going to want or 25-year AM. Now, when is seller financing not ideal? If you're dealing with an institutional seller, probably not on the table. If the seller needs cash. Now, if the seller needs cash, you got to find out how much cash and ideally what do they need the cash for, because that can help you structure the deal. Sometimes it's a hybrid. Sometimes it's a higher down payment, but they're willing to finance and give you better terms on the balance of essentially what they're gonna finance for you. Okay, and then and so those are some of the times where it's not ideal. So let's now continue to build here and move on to private money. Private money is awesome. You should have an army of private money lenders. Now, we'll talk about this, but this doesn't happen overnight. You don't just like wake up and just like, hey, I'm going to go get private. Like, you got to build a relationship with people. They have to know, like, and trust you, generally speaking. But private money can be awesome when you need to close quickly. If you ever need gap funding, if you need down payment money, CapEx money, right? You need to put money into a facility, value add deals that banks won't touch. A private money can be a great option. My third deal, that's exactly what happened. The facility, I think, was like 55% occupancy when we bought it. A bank wasn't going to finance it, but I got a really, really solid purchase price. I mean, I was buying it. It was a 37,000 square foot facility that I was buying for 1.2 million. And I was able to raise 1.45 million in private money, which was amazing. I actually was able to overfund the deal, which gave me some money to put back into the facility and some money to put into my pocket, which was awesome. And 100% of the purchase price, in fact, 105% or 6%, whatever the math is, because I overfunded, was funded by 3 private money lenders that I had built a relationship with. And they knew me, they trusted me, they knew the asset class. I was able to explain to them how I was going to take the asset from here to there. And we were able to pay them off in, I think it was 18 or 19 months that we owned that, or that I owned that facility. I didn't have a partner on that one, and got them fully paid off, all their interest, etc. So in terms of private money, speed is a big pro, flexibility. It's relationship based, like I mentioned. Now, what's cool about that is that you can also negotiate with private lenders. I negotiated with them that they were going to get all their interest along with the principal payoff. So once I sold the facility, I would not only pay the principal balance of the loan, but I would also pay all the interest. So it just accumulated over time. And so that lightened the load for me because this was a value add deal and I didn't have monthly debt service payments. Okay, so that can be a big pro, your ability to negotiate on the rate that you're going to pay them, the term, how you pay them, etc. In terms of cons, private money, it sometimes could be higher rates. You know, you could be paying 9, 10, 11, 12% in private money. It needs to be trust based most of the time. So it can take some time to build that relationship. And then you got to be a strong communicator, and you got to communicate clearly, confidently. You got to always communicate, no matter if it's good news, no news, or bad news. So really, really important. Private money is not ideal when cash flow is going to be thin. And you're like, you don't want to buy a deal where you're needing to come out of pocket just to fund the debt service. If it's a long-term hold, private money might not make sense depending on that particular lender's needs and wants. And that's something that you need to figure out. And if you as an operator, if you are not organized, if you don't communicate effectively and consistently and just then I don't want you to borrow private money and burn a bridge. When you take somebody's money, treat it even better than yours. As crazy as that sounds, like protect that relationship at all costs. The lender needs to know that if something went south, you would get a job at McDonald's just to pay them off before you defaulted on the note. I mean, that might sound a little crazy, but that's what I mean. Like you need to do what you say you're going to do. Your reputation can take years to build, and it can take one bad decision, moment, or instance to completely ruin it. And so protect that at all costs, protect the relationship, protect them and their money. keep something in mind. Lenders first want to know that they're going to get a return of their capital. Then they are concerned with the return on their capital. I'm going to repeat that. They want to make sure that they get a return of their capital first, right? The golden goose, the principal. How is that secure? How is that safe? Then, yes, obviously, they want their money to make money. As Mr. Wonderful would say, they send out their little dollars and they want their little dollars to come back with more friends. Okay, that's the idea here for lenders. And then equity partners can be great when you have a heavy value add deal, when you need experience and credibility, when you maybe want to lower your personal liability, or maybe you don't have cash to put into a deal. Equity partners can be great because it reduces the debt service payments, because maybe they can fund more of the down payment, which will reduce your debt payments. They can share in the risk with you. You have access to their credibility. So those are some reasons you might want to consider. Now, the cons is it can be more expensive in the long run. Ask me how I know. Okay, you're giving up equity. You might have less control depending on what's decided, discussed, and negotiated. Partnerships can be challenging. So if you're going to take on an equity partner, you want to make sure that you have an operating agreement. You discuss everything up front before you even get involved in the relationship. Okay, my first deal, that SBA one, I needed 350 grand to get into the deal, which I didn't have. And so I had a friend who I had done some business with that built a relationship with over years, and he trusted me. He put, I think it was like 365 grand into that deal, and he got equity in the deal. And I found the deal. I did everything. I managed, I operated it, the whole nine. And so he got a pretty sweet deal. But for me, it was speed and convenience. Now, knowing what I know now, I probably would have structured that a little bit differently. But in terms of equity partners, it's not ideal if the deal is just way too small. I mean, it could work, right? It could work, but equity partners, like, they want the juice to be worth the squeeze. Okay, if an equity partner wants full control, that can be a potential challenge. So there's some pros and cons to think through with each of these funding and financing strategies. But when we're talking about local and small banks, any smaller facilities, it can be great. It can also be good for larger facilities, but it's relationship driven financing. All right. You got to have good books and records. Some of the pros is, it can be flexible. It can be great for deals, I'd say under $1 million, under 1.5 million. They want to fund and feed the community. So if you happen to live in a market where you're looking for storage, it can be great. I've had Storage Wins coaching clients that live in Florida or Georgia and are buying deals in Illinois and Missouri and are working with small local banks. You can negotiate with them on the terms a little bit better in terms of a better interest rate, certain amortization schedule. So now in terms of the cons, you typically have lower leverage. They're going to want 25 to 30% down. Maybe you can get a bank that's going to accept 20% down. And it's not ideal if you're going to go in and, like, let's say you're looking at a large facility, let's say over 50,000 square feet, maybe working with a small bank that might not be in their appetite. Every bank has a different appetite. And so it's super important that you shop around and you call all the local lenders, call all the small banks in the area, savings and loans, credit unions, the banks you've never heard of. So you want to shop around. Don't just like call one or two. And if they have an appetite for it, that's who you're going to hitch your wagon to. All right. And then you also have bridge financing. And bridge financing, if it's an ugly, hairy, messy deal, if speed is of the essence, if it's going to be like a short-term period before you refinance, this can make sense. In terms of the pros, it's fast. The underwriting process can be pretty quickly. It can be flexible in terms of the structure. However, it comes with some pretty heavy cons, and that's high interest. You might even pay some points. It's very short term, so you have to make sure that you have a strong exit plan in place and that you're able to execute on that. Super, super, super important. If you don't have a clear exit strategy, if you're shaky on how you're going to get out of the deal, don't put yourself in that position to go bridge financing. If you're new, no experience, you don't have anybody you're working with, you're not part of a community like Storage Wins. If the market is soft, where interest rates are high and things are a little sketchy out there, not ideal. Okay, so protect yourself. Make sure that you understand. I think that's the key thing here. Make sure that you understand all the different options that you have available to you, because there can be market knowns and unknowns. And I think you really need to do your homework. You need to be able to have a business plan, be able to communicate with lenders, and be ready to answer questions that they might ask you about your marketing strategy and how you plan on taking the facility from where it is today to increasing the revenue, increasing the occupancy, and just ultimately generating more net operating income, which is what drives the value of these facilities. So you have to understand the competitor rates, the competitor occupancy. You have to understand, how are you going to execute on your plan, okay? Because banks love when you can anchor your projections and your plans to actual market data. Okay, super, super important. So look, this has been, I think over the last couple of shows, it's been pretty comprehensive in terms of the lending piece. And this is an area that really holds a lot of people back. I want to highlight something before we wrap this one that I covered on the last show. And that's being as organized and professional as possible. Right? Communicating quickly, having all your ducks in a row in terms of the paperwork and the files and how you come across and communicate. Make no mistake about it. They are evaluating you in every aspect as a borrower, because the risk to a lender is you defaulting. They are not in the business of taking back a storage facility. They want to make sure that you succeed, that the facility thrives, and that they get paid. Okay, that is what they want. So professionalism can beat experience. You need to communicate confidently. Even auditing your social media. What image do you portray on social media? And if you don't think banks are looking you up on socials, Facebook, Instagram, X, YouTube, you got it twisted. Trust me, banks are looking you up. Loan officers, underwrite, they're not just checking out the deal. The deal needs to make sense. Okay, it's an asset-backed loan. So the deal and the business has to make sense, but they're also looking at you, your credit worthiness, you as a buyer, you as an operator. So super, super important. Look, make sure that you're subscribed to the Storage Wins podcast, to my YouTube channel, where every single week I'm dropping new content around the storage business, helping you find these deals, how to fund them, and how to close confidently and get them over the finish line. If you want to learn more, I would invite you to schedule a short discovery call with me, storagewins.com, and I look forward to connecting with you if that's you. And if not, perfectly cool. Continue to plug in here week in, week out, and take what you've learned here and apply it to your business.